Okay, so now let's look at the learning objective number 2. Explain the objective of financial reporting and define the elements of the financial statement. Okay, so what is the objectives of financial reporting? Okay, they do not do financial reporting just for fun, right? It costs a lot of money and human power to prepare financial reporting, right? So they don't do it just for fun. There is a purpose, there's objective. So the objective is to provide information that is useful for making decisions about a business. Okay, so for example, you have additional money on hand. You don't want that money sit at the bank account because the interest rate is very low. So you want to invest money, right, in the stock market. There are many different company stocks, right? Which one you are going to invest, right? So you have to make an investing decision, right? So the investors will pull out all the financial statement, financial reporting, right? They will read that information on the financial reporting and to make a decision which one they are going to invest. It could be also for a lending decision, right? If I'm the creditor, I have money, I want to actually lend it to people to earn interest income, right? So I want to know if that business is successful, right? I want to know that business is making enough money, uh, enabling them to pay the interest expense. Right? So the information will be useful for making either investment decision or lending decision, right? For these external users. Okay, the financial reporting, this we are talking about for the external users. Okay, it provides information about economic resources, which is the asset. Okay, and the claims on those resources, liabilities, and equity. Okay, so in the company you have cash, right? You have a machine, you have equipment, you have vehicles, you have properties, you have land, buildings, right? Those are all economic resources, right? Those resources can potentially generate cash flows for you, right? When you start running the machine, right, you probably generate cash flow. When you are using the land, you rent it out, you are generating cash flow. So those resources will, we say it's economic resources. So these are the assets, right? And then the second one is the claims on those resources. Okay, who owned it? So that's the liability and the equity, right? Liability are the portion of these resources owned by the creditor, owed to the creditor. And equity are the portion of these resources owned by the shareholders. Okay. It gives information also about the changes in resources and the claims on that. So not only you know, right, this year, what is my asset, liability, and equity. So the information often provide comparative figures, maybe 2 years, 3 years, up to 5 years. So with those information, you can actually see, right, how the changes in the resources, in the liabilities and equities. Economic performance, it give you the information about economic performance. You'll be able to tell whether the company is profitable or at a loss, right? The objective of financial reporting is also to enable the users to decide whether management use company resources in the best way possible. Okay, so the users, the investors, they are not the person who are performing the daily operations, right? They may own Apple's stocks, but they probably never visited an Apple factory or Apple store, right? So those daily operations are run by the management, CEO of the corporation. But the question is, are they doing the best job, right? Are they managing the resources in the most effective, efficient way possible, right? So when they present the financial reporting information, that will reveal the knowledge of this aspect. So what are the elements of financial statements? So the basic categories are assets, liabilities, equity, revenue, and expenses. Okay, so I don't think any of these are new or strange to you, these categories. It must be precisely defined and applied in the same way by all reporting entities. So all the reporting entities would follow the same definition of asset, liability, equity, revenue, expenses. Okay. So therefore, the precision of the definitions are very important, right? And the application. So for the definition of the assets, liabilities, equities, revenue, and expenses is summarized on this table. Okay. So what is asset? An asset is a present resource controlled by a business as a result of past events, and that has the potential to produce economic benefits. So it's three conditions. First, controlled by the business. Second, as a result of the past event. Third, potential to produce economic benefits. Okay. So if I have a land that is vacant, okay, it's a vacant land. It was not used for anything, right? And you are planning to sell it, right? So, if just think about the future economic benefit, right? If something is sitting there idle, vacant, it does not generate any economic benefit, right? So those ones probably should not be treated as your assets, okay? If it does not generate the economic benefit, right? So if you, for example, sold equipment, right? You sold the equipment, that equipment is not your asset anymore. First, the ownership, the control is transferred, right? You don't have control anymore after you sell the vehicle. The buyer has the control, okay? And the potential of producing economic benefit is on the buyer, not on you, right? So going on the asset you sold probably will generate economic benefit, but it does not generate benefit for you. It's for the other buyer. So that's why when you sold the asset, those ones are not assets anymore. You have to remove them from the balance sheet. A liability is a present obligation. Okay, so not a resource, it's obligation arising from past events, the settlement of which will include the transfer of economic benefit. So this is something you have to settle sometime in the future, and the settlement will demand future economic sacrifices, okay? Future economic sacrifices. An obligation is a duty or responsible that the entity has no practicability to avoid, okay? So if you have this obligation to pay, right, to a party, yeah, you are not able to avoid that, right? You are not avoid it because they will come after you for money, right? If people owe me money, yeah, I will come after them to get my money back, right? So that's the liability. Liability, the settlement of liability will require the transfer of economic benefit. So equity is the residual interest in the assets of the business after deducting all its liability. So what is equity? So basically, they are using the accounting equation to say equity is the difference of asset and liability. Okay. So what is revenue? Revenue are increases in assets or decrease in liabilities that will result increases in equity. Revenue arise in the course of the company's regular business. Okay. So think about regular activities. So if I ask you, for Superstore, right? Okay, Hasley, you have a question?
Yeah, Professor, I was thinking about what you were saying about assets.
Yeah.
So if we have a piece of land that we don't use, and it's not generating like revenue, it would be a liability. Even so, like if I buy it for, I don't know, 50 grand, even if I don't use it in a couple of years, I can sell it for like much more, right?
Yeah.
So it wouldn't be a liability. It would be an asset.
Yeah. So maybe that's not a good example. Like probably I should think more careful about that example. It's not a good example. So let's see, because land always has its value, right? Unless we are saying that land is polluted, right? Let's say the land is polluted, environmentally not suitable for doing anything, right? But that may be not a good example. So I was trying to, let's say this way, right? If you have, let's say, a equipment, right? You use it for many, many years, right? It's reached the end of the useful years of the useful life. Okay, so you are not able to sell it. It's zero. Okay, and there are new technologies. So basically, you will get a new asset, right? So in those cases, you just put that equipment somewhere in the corner and you stop using it, right? You have a new equipment, right? And you are not able to sell it because nobody is going to buy it, and you are just leaving it in the corner, right? And in the future, you are not going to use it because you have a new machine that will be more efficient, right, to generate more money for you, right? So now, if you think about old equipment that is at idle at the corner, right? So it does not generate a economic benefit, right? So you should not keep that equipment as an asset on your balance sheet. So that's what I was trying to say. Does that make sense, Hasley? Hasley, does that make sense? Hello? Am I disconnected?
No,
Hello?
you're back now. Hello?
Hello?
Yeah, we can
Was
hear you
I
now.
disconnected?
Yes.
Oh, that's too bad. Let me see. Okay. So which part I was talking about?
I finishing the definition about assets
Yeah,
with equipment you were trying to explain.
yeah. Does that make sense?
Yeah, I just want to be sure that I had like the concept clear.
Yeah,
Because I was thinking maybe if we see land, like a piece of land,
yeah,
not as an asset, maybe because you have to pay a lot like monthly to, I don't know, keep the grass like cut it, or you have to spend in like people that take care about the land or something, but it's
mhm.
not generating any like value.
Yeah,
But
those
yeah,
are
that's
not
everything.
liabilities. So for land, it's not liabilities.
Oh,
Even
okay.
though you have to do a little bit of maintenance work, right?
Mm-hmm.
But those are not liabilities per se, according to the definition. Okay?
Okay. And
Y-
I have another question.
Yeah.
So a property is or an asset or a liability is like one or another?
Yeah, you cannot be both. So if you are assets, you cannot be a liability, right? So
Yeah.
you can only fit one category, one definition, not the others. So if it's a proper, if it's a liability, it cannot be asset.
Okay. Yeah.
Did I answer your question?
Yeah. Thanks.
Okay, good. So the revenue, they arise in the normal course of the company's ordinary activities. Okay. While gains may or may not arise from ordinary activities. So let me ask you a question. So if superstore, you know our superstore, right? They are selling groceries. So their ordinary activities is to sell groceries, right? What if they sold their truck, okay, and they make some money out of it? They have a gain of let's say 2,000, right? Do you think that $2,000 is revenue? If Superstore sold their old truck and they make $2,000, do you think that's revenue?
No, I don't think so.
No. Why? Why not?
Because they will lose like more money if they don't have like a transportation.
Okay. They will, right? Because they're gonna sell the old one and they will buy a new one, right? So sometimes the trucks are too old, right? They want to sell it. They sell it for a gain. They make $2,000. Do you
Oh, but
think?
probably the new truck is gonna be like more expensive, right? So it
Yeah,
will be expense.
yeah. So they get a new asset, right? A new truck as a new asset. So the question is, if you have a gain, $2,000, are these revenues? Okay, let me ask another example, right? So a car dealership, right? Their normal activities is to sell cars, right? So a car dealership sold a car, they make $2,000. Is this $2,000 revenue for the car dealership? So Superstore sell a car, a truck, and dealership will sell a truck, and they all make $2,000 on that. Do you think it's revenue for both?
Well, according to the definition, if it's an increase in an asset, it might be a revenue, right?
Mm-hmm. What about ordinary activities? So revenue arise in the course of the company's ordinary activities, right? What is the ordinary activity of Superstore? What is the ordinary activity of a car dealership?
Oh, we'll sell cars.
Yeah, so the ordinary activity of the car dealership to sell cars, right? And so they sell this car, they make there is a $2,000 income, so that should be revenue. What about Superstore? What is the ordinary activity of Superstore?
Selling groceries or any other
Selling
products?
groceries, right? They are not a car dealership. They don't sell cars,
Oh, okay.
but they do sell their asset, right? They sell their truck and they make $2,000. Do you think the $2,000 is revenue?
No.
No, right? It's just a gain. We call it a gain, but it's not revenue because selling cars is not the business, right? They are not in the business in selling cars for Superstore. So then when they sell their old truck, they have a gain of $2,000, not a revenue of $2,000. Okay, but the gain will also increase that equity, right? Will also increase equity. But for the car dealership, right, they are in the business of selling cars. So they sell cars, that's their revenue, right? So expenses are decreases in assets or increase in liabilities that result in decrease in equity other than those relating to distribution to owners. Okay, so distribution to owners, those are called dividends, right? So your equity can decrease because you issue the dividends to the shareholders, right? Other than that, expenses will reduce your equity, okay? Expenses will decrease your equity. You'll probably remember, let's see. So what is the return earnings? Oops. Returned earning, right? Opening plus plus revenue minus expenses. That's your net income minus dividend. That equals your ending return earning. Okay, so you can see that for return earning is part of the equity. Revenue will increase return earning, but expenses will decrease return earning. Dividend will decrease return earning. So that's what we are talking about here. Okay. So the revenue result increases in equity because return earning is part of the equity, right? And expenses, okay, result in decrease in equity, right? Okay, does this make sense?
Yeah,
if it
Professor.
makes sense, give me a sum up. 1, 2, 3. Give me a sum up if it makes sense. Anna, Sebastian, do you guys have a question?
Understood.
Okay. How about you, Anna?